What if the safest place for your money is quietly making you poorer? Not through scams, not through bad investments, but through something most middle-class people are told is responsible: keeping too much cash in the bank. This isn't about emergencies or being reckless. It's about a subtle financial habit that feels safe, but slowly drains long-term wealth without anyone noticing. Let's look at a normal, realistic situation. Meet Daniel. He's 29, lives outside London. Or maybe he's Alex in Chicago. The details change, but the pattern is the same. After taxes, he earns about $3,200 a month. Rent takes $1,200, car payment and insurance $450, student loan repayment $300, groceries, utilities, subscriptions around $700. That leaves roughly $550 each month. Daniel has done what financial advice told him to do. He saved aggressively. Over several years, he built a $35,000 balance sitting in a standard bank savings account, earning about 1% interest. He feels safe, responsible, prepared. But here's the uncomfortable part. He might be losing money every single year while thinking he's being cautious. The hidden issue isn't saving. Saving is necessary. The problem is how much cash is sitting idle and where it sits. Most traditional savings accounts in the US and Europe still pay interest rates that lag behind inflation over long periods. Even when rates temporarily rise, inflation often catches up or exceeds them. Let's run simple numbers. Daniel's $35,000 earning 1% interest makes about $350 a year before taxes. But if inflation averages 3%, which is historically normal in many Western economies, the purchasing power of his money shrinks by roughly $1,050 per year. That's a net loss of about $700 in real value annually, even though the number on his bank screen goes up. Over 10 years, that quiet erosion could equal around $7,000 in lost buying power. Nothing dramatic happened, no crisis, no bad decisions, just slow decay. So why do intelligent, hardworking people keep too much cash sitting still? It's not ignorance, it's psychology. Cash feels predictable. It doesn't fluctuate daily like markets do. It doesn't generate scary headlines. And for many people who lived through recessions or saw their parents struggle financially, stability feels more valuable than growth. There's also something called loss aversion. Humans fear losses more than they value gains. Watching investments temporarily drop feels painful, even if long-term math favors growth. Banks reinforce this behavior too. They market security and convenience, not long-term wealth preservation. So people end up overcorrecting. They keep far more cash than they realistically need for emergencies, sometimes years' worth of expenses, because emotional comfort outweighs rational planning. And the system quietly benefits from that behavior. Now imagine Daniel keeps doing this for 20 years. His savings grow slowly through deposits, but inflation keeps eating away at the real value. Meanwhile, someone with similar income, not richer, not smarter, keeps a smaller emergency buffer and gradually moves excess cash into long-term diversified investments. The difference isn't visible year to year, but over decades, compounding works differently. One person's money grows faster than inflation, the other's barely keeps up. By age 50, the gap might not be a few $1,000s, it could be tens or even hundreds of $1,000s, not because one person hustled harder, but because one misunderstood the role of cash. Too little cash is risky, but too much idle cash is quietly expensive. Financially thoughtful people don't see cash as good or bad. They see it as a tool with a specific job. Cash is for stability, short-term safety, unexpected expenses. But beyond that role, they recognize that long-term money needs to at least keep pace with inflation. Otherwise, it's slowly shrinking in real terms. They think in layers: immediate expenses, emergency reserves, and then long-term assets designed to grow over time. There's no drama in this approach, no aggressive risk-taking, just clarity about what each dollar is supposed to do. And maybe the most important shift is emotional. They accept that short-term fluctuations are normal, but long-term erosion is guaranteed if money never moves beyond basic savings. The warning from financial experts isn't that cash is dangerous, it's that excessive idle cash can quietly undermine your financial future, especially for middle-income earners who rely heavily on long-term compounding to build security. Saving money is responsible, but understanding the role of money is smarter. You don't need extreme strategies. You don't need complex systems. Just awareness that safety and growth are different goals, and each dollar deserves a clear purpose. If this perspective made you think differently about how money actually works, consider subscribing for more calm, reality-based financial discussions. And as always, stay thoughtful with your decisions, not fearful.